So, I want to talk through a mid-year strategy change, a couple of changes that I've made as far as my futures trading strategy. It is the middle of the year. It is July 2024. My last end-of-year trading review was through March of 2024. So, technically not the middle of the year as far as how long I've been trading when I look at my year to date since I started March 2023, but it is the middle of 2024. So, I want to talk through some changes that I've made in terms of my overall strategy that I think are going to work for the long haul. So let's kind of get into it. Number one, trading some new markets. So my original focus was on metals, trying to understand the metals market, what moves these markets, looking at economic news, how that might impact the price of gold and silver. But I've actually added these new markets, and reason being is there's some additional opportunities that I think can be overlooked if you aren't looking at these markets. A lot of times there might not be a lot going on in the precious metals, and you may be waiting. And it's not to say that we want to just jump in on any trade, but I think if you can understand the charts and you can understand and have a good strategy that works, it really doesn't matter what market you're trading. Granted, you're going to want to know like what are the positioning, how are people currently trading those markets, why is it going up or why is it going down, what impacts that, what fundamentals will move those markets. But for me, those are really just the entry points. So as long as I know what direction I want to get in on based on maybe crowding, if speculators are all going long, I might want to be shifting to going short when a news event makes sense. As long as I understand the setup, what direction I'm going, and what news event is going to trigger that entry. Everything else kind of can speak for itself. I mean, the chart analysis is all going to be the same. It's just reviewing the data for these different markets and then following the news events that might trigger an entry. So there's not really, it's not a big learning curve to figure out how these markets trade because at the end of the day, this is all human psychology behind trading. These are all going to roughly trade the same way as any other market, and the charts are going to look the same. They're going to go in one direction or another, and we're going to figure out what entries make sense. And then we're looking at commitment of traders, which we'll talk about as far as the setups, and then news events. So those are some new markets. We've also changed our risk mitigation strategy. So originally, when I would enter a trade, I would consider the setup. How good of a setup does this look like? And then that would determine how much risk I'm willing to take on the trade. So trying to really like oversized trades that seem like they're going to go in the direction that I want or, have more favorable probabilities. But I've actually decided against that. And I've noticed in previous trades, the ones where I take a bigger size have actually been the ones that are losers, or I try to stack into a trade as it goes lower and away from the direction I want it to go. And that ultimately just makes the loss bigger. And I think there's no real way of knowing if a trade is going to be good or not when you take it. And this is all just a game of probabilities. So what I've done is I've decided to equal weight all entries. So every position, no matter how good the setup looks, doesn't matter whether it looks good or looks bad. If there's a reason for me to enter based on my system, I'm taking the same trade size for every single one. And the way that size is set up is based on an acceptable risk percentage. So if I'm entering a trade at a certain price point, let's say it's $80, and my stop is for some reason going to be at $79, I am going to size that position based on the maximum acceptable risk I'm willing to take for that position. So if I'm trading $100,000 portfolio and my max risk is 1,000 or 1%, that's going to be $1,000 per trade. So I'm going to size that position so that if it goes from 80 to 79 and I get stopped out, we lose $1,000 on the trade. And then from there, we have price targets that are usually somewhere between 2 and 4x the potential risk. So every trade we're looking at probably making 2,000, 3,000, or $4,000 for risking 1,000 as an example. And it's also knowing you're going to be wrong 50 to 65% of the time. However, if you're letting the winners run and you're cutting those losers short and you're not oversizing and taking on too much risk, you're only losing 1% of the portfolio, then even if you're wrong 6 out of 10 times and you're only right 4 out of 10, 4 out of 10 times, you are going to make money. It's a simple expected value equation. And if we're, winning 3 times the size of the losers, then we only have to be right a third of the time in order to break even. So we're going to be wrong we have to accept that we're going to be wrong, and we have to make sure that we get out of those wrong trades sooner and we ride the winners, because those winners are going to really make up for all the losses. And again, we're not, I'm going to talk about this in a later slide, but we don't know what trades are actually going to go right. If we did, it'd be easy. Everyone would be rich. They would just stack in these positions and everyone would make a ton of money, but that's just not how it works. So cognitive biases and strategic shifts. One, I like to talk about the hindsight bias, right? It's very easy to pull up the charts and say, like, I had one today on palladium. I considered getting into palladium here when it dipped down below 890. And I said, you know what? I'd rather probably wait. Palladium moves very rapidly and violently. I'd rather wait for it to get closer to 870 before I enter. So this chart actually dipped down to 876. I did not take the entry. And I had, in this example, I thought it would bounce off the channel and it would go right back up to the top of the channel. So an easy, 870 to 930 trade. That's $6,000 if you're taking one position, and the risk, I don't know, put a stop around 860, 850 if we go back far enough. That's, this has been down to 850 before. Um, I don't want to take more than a 1% risk on a trade. So Palladium is kind of a big position size. I decided not to take the trade. It went up and I would have had a winning trade there. But we just don't know. We didn't like the setup. We wanted it to go lower for the risk to reward to make sense. And it's easy for a hindsight bias to look back and say, hey, I should have done the trade. I should have known. I mean, there's many examples of that where we would have been wrong, but it's easy to overlook those. Like, oh, I should have, I should have been long here. And then what happens? We have a giant wick at the top and then it starts to sell off. So there's just no real way of knowing. You just have to go based on the odds and know that you're going to be wrong, 6 out of 10 times, and the other four are going to pay for the losers and more. So that's the hindsight bias that we're addressing. It's being okay with, hey, we didn't take a trade and we had all the information we had at the time and it didn't make sense to enter. And if the trade's right or the trade's wrong, it doesn't matter, because it's all hindsight. And the other part is you're not smart, right? Like you're not going to know what direction these markets are going to move. It's all partly hindsight. So not thinking that you're smarter than the markets and that you're magically going to know what opportunities make sense. It's more about just sticking to your system and knowing this system is profitable if we look at previous data, and sticking to that system is going to have consistent results over time, even when you are losing, because you will lose more than you win. It's very likely. So, not thinking that you're smarter than the markets. So, the refined strategy is contrarian investing, as we call it, and it's really going against the grain. So, when the markets are all up and everybody's buying, all the speculators are buying, we want to be looking at going short. And that is partly based on the Commitment of Traders setups. So, the Commitment of Traders report is a report that is published every Friday. It's a set of data that basically allows us to understand the positioning of the commercials, which are people that are typically either using the actual goods or services. So, for instance, if we're talking about corn, it's the farmers, and it's people that are hedging prices, the people that are actually using the goods, these commodities. So, those are the commercials. The speculators are large specs, are like hedge funds. They're going and they're buying based on wanting to make money in trade markets, and then small speculators are like individual investors like myself. And what we want to do with contrarian investing is we don't want to be going where the speculators are going, and we want to actually look for opportunities where they get too crowded. So if the market's going up and up and up, Australian dollar is a great example. There's going to be a time where this trend following system where everybody makes money comes to an end and the trend reverses. It's just not everything goes straight up in the air, and Australian dollar is a really good example of this. It got to a point where everybody was going long and everybody was making money on the trend, and then there became a point where it couldn't go up any further, and all the commercials have been shorting it. So this is on a scale 0 to 100, 100 being max long, 0 being max short. All the commercials are saying short the Australian dollar, and all the speculators are maxed out on going long. And what happens? Well, if we go back to this, we are, if I go jump over a bullet point, trading the news failure, max short and max long. Australian dollar is max long here by the speculators. And then what happens? If we go Australian dollar, we're max long at the top, and then we have some sort of good news about how the Australian dollar or the economy should propel it even higher. And what happens? It goes lower, it sells off. That's a news failure, and that's confirmation that it is completely crowded on the long side and it's time to flip the other way. So we flip the other way, and this thing has just been trading down and down. And yeah, we're in some great profit on that trade. So that is leveraging commitment to traders and the trading the news failure for max short and max long positioning. It works inverse as well. If everybody is going short, eventually there's going to be some bad news on the market that doesn't take it any lower because there's no possible way for anybody else to push it any lower. And then it starts going the other direction. And then eventually shorts start to cover and the price goes up and the direction reverses. So that's trading the news failure. And then the chart analysis setups are reviewing these charts like we've been doing on our weekly calls and looking through and saying, okay, well, there's this channel. It broke the channel. It's likely going down. Probability say it's going to go lower. Um, Palladium's a good example that we just talked about. It's in this channel, right? It's this descending wedge. It's likely going to bounce off the bottom range and head back to the top range. We can look at head and shoulders patterns. We've got a head here. We've got a left shoulder. We've got potential right shoulder. There's just a lot of different opportunities here we can do with chart analysis, right? I mean, we've got this trend line that goes back multiple years that has actually, when it broke up, we could see that it was breakout. And then when it broke below it, now we're back to kind of this bear market. We can look at moving averages. We can look at RSI. We can look at volume. There's a lot of different things we can do with this chart analysis. And that's part of the trading strategy for understanding when and where to enter. Which gets to the entries and exits part. So again, there's always another trade, so we're not worried about missing trades, and we're reviewing that COT setups for positioning and crowding. So as an example here on Palladium, we look at Palladium, and right now we could say, well, it's favoring the downside and it's respecting this channel, right? And we could get in for some day trades on the bottom of the channel or some shorts on the top of the channel. But if we look at the commitment of traders, this is actually determining what side we want to get on for the trade. So if we go to the metals, speculators are getting pretty stacked on the long side and commercials are going short. So we arguably want to be on the short side, or sorry, on the long side with the commercials. So I would favor getting a dip here and a bounce in the bottom of the channel and then going long on Palladium. That is the direction that I would favor based on how the speculators are getting crowded on the long side and how this has been continuing to, or sorry, they're crowded on the short side and this continues to sell off. We're going to look for that trend reversal. We're going to look for some sort of a base forming, some sort of news failure, right? I mean, Palladium, whatever it is, the automotive industry is no longer, thriving, and the use of precious metals like palladium are going down. And then we want to see that sell off, but then reverse. And as soon as it reverses on that news failure, that's going to be an opportunity for us to get in on the long side since the position's already crowded short. So that's an example there of an entry. And we're direction neutral. So I don't want to be thinking of, I know how the market's going to move and, all these things. I mean, you listen to CNBC and you have these guys go on there and, yeah, I think this is my opinion. Opinions don't mean shit in this. We want to be direction neutral. Follow the tape, read the tape. What is the chart telling me? And go with what the market is telling you. What is the price action saying? That's all that matters at the end of the day. It doesn't matter what people are saying or what your opinion is on the price of gold or interest rates. All that matters is the price action in the charts. And then exits. Once we're in a position, we see a setup, we enter. How do we get out? Australian dollar being a good example of this. So, how do we know when to get out of this? Well, we set some price targets. So, for instance, we set some price targets for this to retrace maybe back to the swing lows, or the 618 Fibonacci might be an area where we take some profit. But I'm looking at taking profit on specific markets when it's somewhere between 2 and 4x return. So if I risked $1,000, if we're at $2,000, I may take partial profit depending on the market. If it's more of a steady market that really follows a trend, like Australian dollar, we're probably going to take some profit at 4x return. So if this is at a $4,000 profit, we will take partial profits since it 4x the risk that we took. So that is part of the exit. And then the other is exiting once COT is neutral. So once anyone on the COT index, Australian dollar as an example, 2 are short, so max short for commercials. 98 and 99 are max long for the speculators. As soon as one of those goes back to neutral, we're going to exit that position. So that'll be, either waiting for the COT data on Friday when it gets released from the following Tuesday and making some estimations, or using a model that I've built in Python to identify what might be the current setup based on that historical data. If we're in the middle of the week, we don't want to wait for COT data the following Friday, which only runs up to that previous Tuesday. We might make an estimation based on a model that we've built using historical data. So those exits is really about letting the runners run and cutting the losers faster. We don't want to be taking profits on a trend where it continues to run up. And that may mean giving up some profits as well. It may mean that we're in a bunch of profit and a position reverses. But, if a position reverses and you were to exit and take profit, you're running the risk of taking profit on a trend that might continue. So you don't want to just exit to take profit for sake of taking profit. You want to either have profit targets, or you want to have a specific system for exiting. And for me, it's that neutral COT reading. So that's the update here. And we will continue to post status updates, year-end reviews, probably half-year reviews as we continue on here and see how the system works and make any refining that we need to make. Thanks a lot.